Today, we're digging into an investment thesis on AMC.
Yeah, it's called From $2 to $4, the bull case for AMC's comeback.
It argues for a huge upside, pinning its hopes on some debt restructuring and a big Q4 2025 movie slate. Let's get right into making it stronger.
Okay, so let's start with the big one.
The debt? I mean, the writer's aiming for that $4 target, but Wall Street is looking at that mountain of debt.
You have to. The thesis makes a decent case that restructuring buys them time, pushing maturities out to 2029, 2030.
But just kicking the can down the road, does that really solve the fundamental issue of a $9 billion debt problem?
And that's the disconnect. The narrative needs to proactively address the massive $9.0 billion enterprise valuation and subsequent debt burden, which currently drives the negative net income.
So the piece sort of presents the extension as a total fix.
Exactly, like the risk is just gone now. And Wall Street isn't buying that. That's why you still see a hold rating. The debt itself is what's keeping net income so negative. I think it was, a $298.2 million quarterly loss?
Right, and the analysis acknowledges the negative free cash flow, but it doesn't quite connect the dots. It never shows how that amazing movie slate actually fixes the cash burn.
It doesn't. So the suggestion is to get very, very specific with the metrics. You have to show how that forecasted revenue growth translates directly into an ability to service the debt.
You have to draw the map for the reader.
Precisely. For example, use the projected $5.35 billion revenue forecast for 2026. Show how that starts chipping away at the negative $81.1 million in free cash flow.
Or how it helps turn that small operating income they posted into real, sustained net profit after you pay those huge interest bills.
Yes. That's how you change the story from simple survival to an actual credible recovery.
Okay, that clarity is key. And, building on that, I think the timeline in the piece is, well, it's confusing. It really hurts the conviction.
It feels like you're mixing apples and very distant oranges.
That's a great way to put it.
Delineating the short-term technical trade from the long-term fundamental thesis will strengthen the conviction.
The weakness right now is that it's blending the immediate technical setup like an RSI of 27 and a double bottom forming
with this distant fundamental price target of $4 that relies on Q4 results we won't even see until February 2026.
It makes the whole thing feel really fuzzy, doesn't it?
So the suggestion is simple. Separate the argument into two distinct phases. Call it Phase 1, the technical bounce,
and Phase 2, the fundamental breakout.
Right, and give the reader specific actionable triggers for each. So you frame the bounce from, say, $2.17 back to the 50-day moving average and maybe $2.60 as the immediate trade.
A trade driven purely by oversold conditions.
Purely technical. Then you state very clearly that the bigger move, the one towards that $3 or $4 target, is contingent only on confirmed box office success in December.
From movies like Avatar, Fire and Ash.
Exactly. So the reader knows what they're betting on and when.
Okay, let's talk about the last point. There is a stat in this piece that is just absolute gold, but it's completely buried.
Oh, I know exactly which one you mean. It's the perfect counter-narrative.
The revenue per patron.
Yes, maximize the impact of the highest performing counter-narrative, the record revenue per patron.
Right now, the fact that revenue per patron hit an all-time high, $12.25 for admissions, is just like a random bullet point.
And it totally undermined its own power against that lazy death of cinema narrative. This stat needs to be a canon, not a footnote.
So the suggestion is you elevate it, make it the core of the bull case. AMC isn't just a survivor, it's become a successfully premiumized service.
It has. They're optimizing for consumer spend. So reorder the whole introduction, lead with the secured debt runway, sure, but immediately follow it with this killer fact.
So the argument becomes, fewer people might be attending, but
the ones you do attend are spending way more than ever before. Use that $12.25 figure as the proof that the business model, while smaller, is actually more efficient.
That's the most powerful point you can make to a skeptic.
It's the central pillar of the argument.
Okay, so to summarize. First, tackle the debt head-on and show exactly how that future revenue will reduce the burden.
Connect the blockbusters to the balance sheet.
Second, clearly separate the immediate technical trade from the long-term fundamental catalyst.
2 phases, 2 sets of triggers. Simple.
And finally, take that record revenue per patron statistic and make it the headline of your entire argument.
Make it the core of the bull case.
If you can implement those changes, this analysis will be much more compelling. We'd look forward to seeing the revised version.